Everyone is watching the silver price. Charts refresh every second. Numbers flash green and red. Commentators argue over targets, resistance levels, and breakouts. But almost no one is watching the one thing that actually matters: silver availability. And throughout history, whenever availability disappears, price becomes irrelevant. Because when something cannot be sourced, the price you see on a screen is no longer a price, it's a memory. As of late 2025, the global silver market crossed a line it may never return from. Not because silver became expensive, but because silver became unobtainable. This is not a bull market. This is not a shortage cycle. This is not manipulation or speculation. This is a system failure. And system failures don't announce themselves with explosions. They happen quietly, structurally, invisibly, until suddenly, nothing works. Silver today still trades on paper. Contracts change hands. Prices update. But the physical metal, the real silver, has begun to disappear. Not vanish, not run out. Disappear into places it will never return from. London vaults, once the heartbeat of global silver liquidity, are no longer functioning as markets. They are functioning as storage facilities for metal that is not for sale. Bid prices exist, offers do not. You can see a price, but you cannot complete a transaction. And when a market reaches that state, it has already failed. Because a market only exists if sellers exist. This is the moment when silver stops behaving like a commodity and starts behaving like a strategic asset. A material that is no longer priced by supply and demand, but allocated by priority. An allocation is the opposite of a free market. Allocation means someone decides who gets access and who does not. Allocation means price becomes secondary. Allocation means retail buyers are always last in line. The real question is no longer, how much does silver cost? The real question is, who is still willing to sell? And increasingly the answer is no one. This transition did not happen overnight. It took decades of neglect, mispricing, and misunderstanding to reach this point. Silver was treated as expendable. Gold was preserved. Silver was consumed. Gold was stored. Silver was used. Gold was hoarded. Silver was burned. And the world built an entire technological civilization on the assumption that silver would always be available, always cheap, always replaceable. That assumption is now breaking. Unlike gold, silver is not primarily an investment metal. It is an industrial input. Once silver enters a circuit board, a solar panel, a missile guidance system, or a medical device, it rarely comes back. It disperses. It degrades. It is destroyed. Recycling recovers only a fraction, and often at a cost that exceeds mining. And mining itself is no longer flexible. Most silver is not mined directly. Over 70% of global silver production is a byproduct of copper, lead, and zinc mining. That means silver supply does not respond to silver price. If copper slows, silver slows. If base metals stall, silver disappears. And right now, base metal investment is frozen. Exploration budgets have been slashed. Permits take a decade. New mines face political resistance, environmental delays, and capital shortages. Even if the world approved every viable silver project tomorrow, meaningful supply would not arrive until the mid-2030s. Silver does not have that much time, because demand is no longer optional. Artificial intelligence infrastructure requires silver. Data centers require silver. Solar energy requires silver. Electric vehicles require silver. Defense systems require silver. And these sectors do not substitute. They do not downgrade. They do not delay. If silver is unavailable, the project fails. An AI data center cannot operate without silver-based electrical reliability. A solar panel cannot function without silver paste. A missile system cannot be produced without silver-based electronics. This is why governments quietly reclassified silver. Not publicly, not loudly, but administratively, as a critical strategic material. And once that classification occurs, the market changes permanently. Strategic materials are not traded freely in times of stress. They are reserved, allocated, prioritized. And when that happens, civilian access collapses first. This is why retail shortages always appear before institutional shortages. And institutional shortages appear before state shortages. By the time governments admit scarcity, scarcity has already existed for years. The paper market masks this reality. Futures contracts continue to trade, options continue to clear, charts continue to move. But physical settlement becomes increasingly difficult. Delivery delays stretch. Eligible inventory replaces registered inventory. Lease rates spike. These are not price signals. They are stress signals. Backwardation begins to appear, not because traders expect lower prices, but because immediate delivery carries a premium. And backwardation in a monetary metal is a warning flare. It signals that possession now is worth more than possession later. That trust in future delivery is eroding. That paper claims are diverging from physical reality. And silver is uniquely vulnerable to this divergence, because the paper silver market is many multiples larger than the physical silver market. Promises vastly exceed metal. As long as few people ask for delivery, the system holds. But when demand shifts from price exposure to physical possession, the system fractures, and that shift has already begun. Not among retail investors chasing gains. Among industries securing supply. Long-term contracts are being signed. Inventory is being locked away. Metal is being removed from circulation. Not to speculate, but to survive. This is the most dangerous form of demand, because it does not reverse when prices rise, it accelerates. When supply becomes inelastic and demand becomes non-negotiable, price ceases to function as a balancing mechanism. Markets rely on price to ration scarcity. But strategic demand ignores price. If silver costs more, the project absorbs the cost. If silver becomes scarce, the project collapses. And collapse is not an option. So silver is acquired at almost any cost, quietly, contractually, invisibly, leaving the open market hollowed out. What remains is an illusion of liquidity, a market that exists on screens, but not in vaults. And this is the phase where most participants misinterpret what they are seeing. They see stable prices and assume stability. They see slow movement and assume normalcy. But stability during scarcity is not safety. It is compression. It is pressure building beneath the surface. And when compression releases, it does not drift, it snaps. Silver has entered that compression phase, the stage where supply constraints are hidden, demand is locked in, and price is artificially restrained by paper mechanisms. This phase never lasts long. Historically, it ends in one of two ways. Either delivery fails openly, forcing a reset, or price gaps violently to levels that shock demand destruction. But silver does not destroy demand easily, because demand is structural. Technological civilization does not turn off because silver is expensive. It turns off if silver is unavailable, and that difference changes everything. Gold responds to fear. Silver responds to necessity. Gold is stored for insurance. Silver is consumed for function. Gold can wait. Silver cannot. This is why silver crises do not resemble gold rallies. They resemble resource emergencies. And resource emergencies do not unfold gradually. They accelerate suddenly. The most dangerous moment is not the spike. It is the silence before it. When nothing seems wrong. When the market still functions. When only insiders notice that offers are gone. That dealers whisper instead of quote. That delivery times stretch without explanation. That inventory data shifts categories quietly. That the word allocation appears where order used to be. These are the signals of a market transitioning from exchange to rationing. And rationing is the end of price discovery. Once allocation begins, price becomes administrative, not market-driven. And at that point, the public is no longer participating. They are observing. By the time headlines declare a silver crisis, the metal will already be gone. Because availability disappears before price reacts. And the people who understand that do not wait for confirmation. They move before the signal becomes obvious. Silver is not entering a boom, it is exiting the market, and when a commodity exits the market, it does not return easily. It returns redefined, repriced, recontrolled. This is not a theory. It has happened before with oil, uranium, rare earths, and strategic metals throughout history. The pattern is always the same: ignored, underpriced, consumed, restricted, allocated, and then suddenly indispensable. Silver has reached the indispensable stage. And the world is only beginning to realize what that means. The most dangerous misunderstanding about silver is the belief that high prices will solve the shortage. That belief comes from textbook economics, not from reality. In textbooks, higher prices reduce demand and increase supply. In real strategic markets, higher prices do neither. Silver is no longer a discretionary input. It is a required component embedded into systems that cannot function without it. Artificial intelligence is not software alone. It is physical infrastructure. AI runs on data centers, massive structures consuming enormous amounts of electricity. That electricity must be distributed with extreme reliability, minimal resistance, and zero tolerance for failure. Silver is used throughout that electrical architecture, not because it is cheap, but because it works. High performance connectors, high frequency switches, thermal management systems, power conditioning hardware. Silver is used because no other metal matches its conductivity, reliability, and durability under extreme loads. You cannot downgrade silver in an AI data center without increasing heat, resistance, and failure risk. And failure risk in AI infrastructure is not acceptable. A single outage can cost millions. A single instability can destroy models trained over years. So AI operators do not negotiate with silver prices. They secure supply. They lock it in years ahead. They remove it from the open market entirely. And AI is not slowing down. Every nation is racing to build compute dominance. Every corporation is racing to deploy more capacity. This is not cyclical demand. This is an arms race. Solar energy tells the same story. Every solar panel requires silver paste to collect and transmit electricity. The amount per panel has been reduced over time, but not eliminated, because physics does not negotiate. You can thin silver usage. You cannot remove it. And as global solar deployment accelerates, total silver consumption rises, even as efficiency improves. More panels multiplied by slightly less silver still equals more silver. And solar demand is not price sensitive. Governments mandate it. Utilities require it. Energy security depends on it. If silver prices double, solar does not stop. The cost is passed through. Electric vehicles follow the same pattern. Each EV uses significantly more silver than a combustion vehicle. Battery management systems, power electronics, charging infrastructure, all silver dependent. And EV adoption is not driven by consumer preference alone. It is driven by regulation. When governments mandate EV adoption timelines, manufacturers do not ask whether silver is expensive. They ask whether silver is available. Defense systems are even more rigid. Missile guidance systems, radar platforms, secure communications, electronic warfare equipment. Silver is embedded throughout. Defense supply chains do not substitute away from silver. They overpay for it. Because national security does not accept alternatives that increase failure probability. This is the core misunderstanding in the silver market. Demand is not speculative. It is structural. It does not retreat when prices rise. It accelerates. Because rising prices signal scarcity, and scarcity triggers hoarding. Industries do not wait for shortages to materialize. They preempt them. They sign long-term contracts. They stockpile inventory. They lock supply away from the market. Every ounce locked in this way is an ounce that never returns. This is why recycling cannot solve the problem. Silver recycling recovers only a portion of consumed silver. Much of it is too dispersed, too degraded, or too embedded to recover economically. Tiny amounts in electronics, thin layers in solar cells, microscopic quantities in medical applications. The cost of recovery exceeds the value recovered. And even when recycling occurs, it does not scale fast enough. It lags demand by years. Mining cannot solve the problem either. New silver mines take a decade or more to bring online. Permitting, financing, construction, infrastructure. And silver is rarely the primary target. Because silver alone rarely justifies a mine, this means silver supply is hostage to base metal economics. If copper demand slows, silver production falls, even if silver demand explodes. This structural mismatch is fatal to market balance. Demand responds instantly, supply responds slowly or not at all. And this imbalance is now locked in. The silver market is no longer adjusting. It is tightening, quietly, systematically. Every quarter that passes without new supply deepens the shortage. Every contract signed removes liquidity. Every strategic stockpile reduces float. This is why visible inventory numbers are misleading. Reported inventory does not equal available inventory. Metal can exist in a vault and still be unavailable. Eligible is not registered. Stored is not offered. Owned is not for sale. And increasingly, silver exists only as accounting entries. The physical metal is spoken for. This is why market participants report the same experience again and again. Prices quoted, metal unavailable. Delivery delayed, quantities restricted. Minimum orders raised, premiums widened. And always the same explanation. Supply chain issues, temporary delays, logistical constraints. But these are not temporary, they are structural. This is what a market looks like when it has already crossed the threshold. The threshold where price no longer balances supply and demand. The threshold where access matters more than cost. The threshold where allocation replaces exchange. Once a market reaches this stage, it does not heal easily. It resets. And resets are violent. Because paper claims must reconcile with physical reality. Either delivery fails, or price explodes to levels that ration demand brutally. But in silver's case, rationing demand is extremely difficult, because demand is embedded into systems that cannot be turned off. So the adjustment pressure builds, and builds, and builds, until something breaks. This is why the most important signals are not prices. They are delays. They are restrictions. They are silence. The silence where offers used to be. The silence where liquidity once existed. The silence before the snap. To understand why silver's crisis is so dangerous, you have to understand how the modern silver market actually works. Not the simplified version shown on trading screens, but the machinery beneath it. Silver does not trade primarily as metal. It trades as promises. Most silver transactions never involve delivery. They are offset, rolled, settled in cash, or netted against other positions. This system works only as long as confidence exists. Confidence that metal will be there if someone asks for it. Confidence that delivery is possible, even if rarely requested. The moment that confidence weakens, the system begins to fracture. London sits at the center of this structure. The London bullion market is not an exchange in the traditional sense. It is an over-the-counter network of vaults, banks, and clearing members. Trades occur as unallocated balances. Unallocated silver is not silver you own. It is silver someone else owes you. It is a claim. And the number of claims has grown far larger than the metal backing them. As long as most participants are content to hold claims, the imbalance remains hidden. But when participants start asking for allocation, for real metal, the imbalance is exposed. Allocation means converting a paper claim into specific bars with serial numbers sitting in a vault. And that conversion is where the bottleneck appears. Because there are far more claims than bars. In normal times, this does not matter. But when availability tightens, it matters immediately. Requests slow, processing delays appear, rules change quietly, minimum sizes increase, waiting periods lengthen, fees rise. None of this is announced as a crisis. It is framed as operational adjustments. But operational adjustments are how markets ration scarcity without admitting it. COMEX functions similarly. Futures contracts are theoretically deliverable. In practice, almost none are. The system assumes that most contracts will be settled financially, not physically. That assumption holds only if participants accept cash in place of metal. When even a small percentage demand delivery, pressure builds quickly. Registered inventory falls. Eligible inventory rises. This shift is critical. Registered silver is available for delivery. Eligible silver is not. Eligible silver may sit in the same vault, in the same building, but it belongs to someone who has not agreed to sell. Counting eligible inventory as available is a misunderstanding. It is metal that exists, but cannot be accessed. And this distinction is now dominating the silver market. Reported inventory looks stable. Deliverable inventory does not. As registered stocks decline, the system becomes fragile. Every new delivery request draws from a shrinking pool. And when that pool reaches critical levels, exchanges face a choice: force cash settlement, delay delivery, change rules. All three are forms of default. Not legal default, but functional default. The moment a buyer cannot receive metal on schedule, the promise has failed. This is why backwardation is so important. Backwardation means silver today is more valuable than silver tomorrow. Not in price terms, but in trust terms. It signals doubt about future delivery, and doubt spreads faster than any price move. Once participants begin to question delivery, behavior changes. They stop rolling contracts. They stop accepting cash. They demand allocation. This is how paper markets unwind, not all at once, but suddenly. This is the phase silver is approaching, where the system still functions until it doesn't. And when it doesn't, resolution is not gradual. It is abrupt, because paper claims must reconcile with physical limits. This is where price loses meaning. If you cannot deliver metal at the quoted price, the price is wrong, not because it is low, but because it is imaginary. In past commodity crises, this moment has always triggered a reset. Uranium, palladium, nickel, each followed the same script. Long periods of calm, structural underinvestment, rising strategic demand, then a sudden break. Silver is different only in scale, because silver underpins more systems than almost any other metal, and because its paper market is enormous relative to its physical supply. This makes the reset potentially violent and difficult to control. Once confidence cracks, trust evaporates. Participants rush not to sell, but to secure. And when everyone tries to secure at once, liquidity vanishes. This is why markets collapse upward, not through bidding wars, but through absence. No offers, no size, no certainty, just silence. The kind of silence that precedes repricing. When governments step into a market, they rarely announce it as intervention. They describe it as stability, security, resilience. But the effect is always the same. The market stops being a market. Allocation replaces price. This transition has happened many times before, and it always follows the same pattern. First, a resource becomes strategically important. Then supply tightens quietly. Then governments classify it as critical. Finally, access becomes regulated. Silver has now entered this phase. Not publicly, administratively. Once a material is designated strategic, it is no longer governed solely by market forces. It is governed by priority. Who needs it most? Who can pay least political cost? Who cannot afford interruption? In that hierarchy, retail buyers do not exist. Retail demand is considered optional. Industrial demand is considered essential. Defense demand is considered non-negotiable. And so allocation begins. Manufacturers receive quotas. Suppliers receive directives. Exports are monitored. Stockpiles are built. None of this appears on a price chart. But it changes everything. In an allocation system, price serves a different role. It no longer balances supply and demand. It merely signals scarcity, and scarcity signals hoarding. This creates a feedback loop. As scarcity becomes visible, Buyers rush to secure future supply. That future supply disappears from the market. Scarcity deepens. This is how markets tip from equilibrium into control. History is full of examples. During wartime, metals disappear from markets not because they are expensive, but because they are reserved. Copper, nickel, uranium. Each was once freely traded. Each became allocated. Each emerged later at dramatically higher prices and under tighter control. Silver is following the same trajectory, but with one critical difference. Silver is embedded in civilian technology at a scale few metals ever were. That makes rationing more complex. You cannot easily decide which technologies function and which do not. You cannot turn off solar grids. You cannot shut down data centers. You cannot halt defense production. So allocation becomes layered. Large buyers get priority. Smaller buyers get delayed. Spot buyers are excluded. The market fragments. And fragmentation destroys transparency. Prices no longer reflect reality. Different buyers pay different prices. Contracts include confidentiality clauses. Premiums vary wildly. This is why public silver prices lag reality. They reflect paper transactions, not physical access. By the time price catches up, allocation has already been in place. This is the danger zone, where price still appears reasonable, but availability is already gone. Where people believe they have time, they do not, because allocation systems do not reverse easily. Once a government begins managing supply, it rarely relinquishes control. Not until a crisis passes, and silver's crisis is not short-term. It is structural. Mining cannot respond quickly. Recycling cannot scale. Demand cannot retreat. This means allocation will persist, and persistent allocation changes behavior permanently. Producers stop selling spot. Buyers stop relying on markets. Contracts replace exchanges. Liquidity evaporates. The open market shrinks. What remains is a shell. A quoted price without depth. A market in name only. This is the stage where silver becomes something else. Not a commodity, not money, but infrastructure. And infrastructure is not traded freely. It is protected. This is why silver's future does not resemble a traditional bull market. There will be no smooth ascent, no orderly revaluation. There will be gaps, discontinuities, moments where price jumps not because someone bid, but because someone withdrew. And withdrawal is more powerful than demand, because it removes choice. This is the unobtainium phase, the phase where silver exists, but not for you. Where ownership becomes less important than access. Where having money is irrelevant if there is nothing to buy. This is not speculation. It is the logic of scarcity applied to an indispensable material. And it is already underway. To understand why silver behaves so differently from gold, you have to abandon the idea that they are the same kind of asset. They are not. Gold is accumulated. Silver is consumed. Gold is preserved across generations. Silver is destroyed by use. Nearly every ounce of gold ever mined still exists in some form. Vaulted, stored, recast. Silver does not enjoy that luxury. A large portion of all silver ever mined is gone, lost in landfills, dispersed in electronics, embedded in infrastructure. Once silver performs its function, it rarely returns to circulation. This single difference changes everything during periods of stress. When gold becomes scarce, it is released. When silver becomes scarce, it vanishes. Gold holders can be induced to sell with higher prices. Silver users cannot, because selling silver often means shutting down systems, and systems do not shut down voluntarily. This is why gold shortages produce rallies. Silver shortages produce emergencies. Gold scarcity creates fear. Silver scarcity creates failure. And failure is intolerable in modern civilization. This is why silver crises resolve violently, not through steady price discovery, but through sudden repricing events. Because the market cannot ration demand smoothly, it must shock it. But silver demand is unusually resistant to shock. When gold prices spike, jewelry demand collapses. When silver prices spike, solar production does not stop. AI infrastructure does not pause. Defense systems do not wait. The cost is absorbed. This creates a paradox. Higher prices do not reduce demand, but they do signal scarcity. That signal accelerates hoarding. Hoarding removes supply. Supply removal drives further scarcity. This feedback loop is unstable. And instability always resolves in a break. The silver market is already showing the early signs. Rising premiums, shrinking bar availability, longer delivery times. These are not signs of a healthy bull market. They are signs of exhaustion. Exhaustion of supply, the moment when the system is running on inventory rather than flow. Once inventory is drawn down, there is nothing left to buffer demand. At that point, price loses control, and when price loses control, allocation takes over. Silver becomes a priority-based resource, not a traded one. This is why the silver price often appears suppressed right before major moves. It is not being suppressed in the conspiratorial sense. It is being capped by a system designed to function smoothly. But smooth function requires confidence. And confidence erodes quietly. By the time confidence breaks, price adjustments are no longer linear. They are discontinuous. This is the moment markets fear most, because it is unpredictable. It is not driven by sentiment, but by necessity. And necessity does not negotiate. Silver is approaching that necessity threshold, the point where its absence causes immediate disruption. At that point, price becomes secondary. Access becomes everything, and access is limited. This is why silver's future cannot be modeled with traditional tools. Supply curves do not bend fast enough. Demand curves do not slope downward. The normal equations fail. This is a resource emergency unfolding inside a financial market. And financial markets are poorly equipped to handle emergencies. They rely on liquidity. Emergencies destroy liquidity. Once silver fully enters this phase, it will not behave like a normal asset again. It will behave like energy, like water, like something society cannot function without. And things society cannot function without are not left to chance. They are controlled. That control may be subtle or overt. But it always removes freedom. The freedom to buy at will. The freedom to sell at will. What remains is rationed access. And rationed access always precedes repricing. Not gradual repricing, but repricing that reflects scarcity rather than convenience. Silver has not yet reached that repricing, but the conditions for it are now locked in. And locked in conditions do not reverse easily. One of the most persistent myths surrounding silver is the idea that its price is being artificially suppressed. This belief is comforting because it implies control. It suggests that if suppression ends, everything resolves cleanly. But this framing misses the real danger. The silver market is not being suppressed. It is being delayed. And delay is far more dangerous than suppression. Suppression implies intent. Delay implies fragility. Paper mechanisms exist to smooth volatility, not to hide collapse. Futures markets, derivatives, leasing structures, these are designed to absorb shocks. They work well in normal shortages. They fail in structural ones. Silver's problem is not that price is wrong. It is that price is irrelevant. Price can only function when supply exists. When supply disappears, price becomes a placeholder. A number representing a transaction that cannot actually occur. Paper markets can delay this realization. They cannot prevent it. They can create the illusion of balance long after balance is gone. This illusion persists because most participants do not demand delivery. They trade exposure, not metal. As long as exposure satisfies them, the system holds. But the moment exposure is no longer enough, everything changes. That moment does not arrive evenly. It arrives asymmetrically. One sector moves first, then another. Then suddenly, everyone notices. The first movers are never speculators. They are users. Industries that require silver for function, not profit. They secure supply quietly. They do not announce it. They do not chase price. They remove metal from circulation. This removal is invisible to charts, but it shows up in delivery statistics. in lease rates, in availability, and availability is the earliest signal. The next signal is behavioral,